Okay, Tyler Crow. A lot of people have gotten really interested in dividend stocks over the past year and a half, which is a little ironic considering that safe yield has become more available through things like T-bills yielding 5%. But I get it. You buy great dividend paying companies. Over the long term, those companies grow the dividends. Your yield on your cost continues to grow. The companies become more valuable. You compound your wealth. But there's an, I think, underappreciated risk for a lot of those high yield dividend companies that you and I want to have a conversation with, and that's their cost of capital, the yield that they pay to fund the growth of their business and the assets that they own. Tyler, are you ready to talk about that risk, and maybe even better for people that are listening, some ideas for where they can invest that might be less exposed to that risk?
Hey man, we're here to talk about at-risk capital. It's a fun topic, something I love talking about.
Yeah. Yeah. I'm looking forward to this conversation for sure. I'm Jason Hall. This is The Smattering. Our videos are sponsored by The Motley Fool. So if you're looking for even more great stock ideas than the ones that we're going to talk about in this video, please check out our special link, fool.com/The Smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check out that link. Okay, Tyler. So let's get right to it. We've seen investors move towards these high yield stocks looking for security, looking for stability. Hasn't necessarily worked out really well because a lot of those stocks have fallen even more because of partly the pressure that you're going to talk about. And it's pushed the yield up even more and made some of them look even more attractive. What is that threat and why is it a real concern?
It's interest rates, baby. And it matters so much more than I think people will are willing to give it credit for. In large part because we have gone a very long time in the absence of interest rates. It's a what was it over the since 2008, 2009, we've been in a very, very low interest rate environment. So for a lot of us, I actually, even you and I included, for pretty much most of our investing life, we've been investing in these relatively low interest rate environment.
Money wasn't only cheap in 2020 and 2021. It's been cheap, like you said, it's been cheap was basically for 13 years, 14 years. Money was very cheap.
Yes.
That's been great for stocks. And that's been great for a lot of these companies that you're going to talk about here. But the worm has turned, so to
Yes.
speak.
So with the rise in interest rates, it means that anybody that has debt and is going to refinance that debt, they're going to have to refinance it at higher rates. It's just an inevitability. It's not something that's going to happen tomorrow.
Yeah.
Refinancing happened many, many years because debt is what we call termed out. It's some's due in 2024, some's due in 2026, however you want to say that.
Well, and I want to highlight this, Tyler, because there's kind of the dirty little secret of corporate debt that the average investor may not even realize. And that's it's not structured the same way that your car loan is or your home loan, which it's
Yeah.
amortized, right? The principal is amortized over 5 years or 7 years or 15 years or 30 years. And when you make that last payment, you have paid off the debt completely. Essentially, all corporate debt, not all, but it's a rounding error from all corporate debt, certainly maybe low single digit percentages that are amortized. This is interest only
Right.
loans, right? They're basically
Yep.
bonds or unsecured debt where all you're doing is paying an interest on it. And then once it matures, you've got to roll it
Yep.
over, right? That's the common term that's described for refinancing that debt. And that's what we're talking about here, right? The company that took out that $1 billion debt 7 years ago when the term is coming up, they're not going to have paid off the debt. They've got to
Some of the smart ones right now are probably retaining cash so they don't have to refinance as much debt. That would be a responsible management thing to do. But when refinancing happens, it means that the interest rate is going to go up, which means that interest payments go up. And it means that companies that are running very, very high levels of debt over very long periods are going to see significant increases in their interest rate expenses. And so you can look across the investing landscape and what are some of the high companies or businesses or industries that tend to have a lot of leverage, right? Talk about oil pipeline companies, utilities, real estate. A lot of companies where they're very long-term contracted cash flows that you can price out over 20, 30 years and you can underwrite, how it's going to all work out. Well, when the interest rate payments on those changes significantly, it's going to, have an impact. Now, I want to give an example of this because I think it doesn't sound like a big deal, but I was going through Enbridge's annual report. And I think this helps to contextualize everything that I'm talking about here. In 2022, fiscal year 2022, it repaid or refinanced a decent portion of debt. the weighted average, basically, if you took all the debt that it paid down and you looked at interest rates and how much it did, the weighted average of its interest rate on all the debt that it refinanced or repaid in 2022 was 3.45%. At the same time, it issued, in large part, either as much or a little bit more. I think that they issued a net about $6 billion in debt in 2022, Enbridge did. And in 2022, the weighted average interest rate on the debt issued was 5.52. So we went from 3.45 to 5.52 in 2022. It gives you,
I want to sit on that for just a second, Tyler, because people might hear it and say moving from 3 to 5 that's not very much. But this is one where you have to look at the percentages, because paying 3.4 versus paying 5.5, you're looking at, what is that, roughly a 50%, about a 45% increase in interest expense on that debt.
exactly.
So again, it's not a 2% increase. It's a 45% increase in its interest expense. That'll
For
increase
that set of debt, not for its
for
entire debt.
for that. But again, we can use that, and we can think about its as its next debt ladder matures and matures. As long as interest rates stay persistently higher, we'll see its interest expense continue to rise with each passing year. That's the
Yeah.
concern.
And so if you're looking at dividend investments, typically the ones that we all just mentioned, they are stable, high yield businesses, but they grow slowly, right? And so when you
Mhm.
buy these sort of investments, the yield has to compensate for the fact that it's a slow growing business. And in higher interest rate environments where you can get debt at, my money market right now is almost 5%. You can go get a 6-month CD, I think, for 5.5. When you have these alternatives that have higher yields, you would expect a riskier investment. Your equity,
Right.
you are the at-risk
Right.
capital in a business that should have higher returns. And if it's slow growth, you want even higher yield. And so I think that a lot of these companies that are paying decent yields but have no growth, if you compare it to the debt that is currently available to investors, it's not as attractive. I'm going to give a very obscure reference because it just happened to be one that I was looking at today. It's called Federal Realty Trust. It's a strip mall REIT, a very well-run business, but very slow growth, decent yield, I think somewhere in the 4% range. It's been paying a dividend for 56 years straight. Great track record of paying dividends. Right now it has about 4.6%. Through the 1990s, when it was a relatively similar business, more or less doing the same thing, slow growth, high yield, very well executed business, that exact same business, its yield through the 1990s, when we had similar interest rates today, was closer somewhere between 6.5 and 8%. And so if you take that into context and say, well, why is something today that, is has a yield of 4.6% at similar interest rate levels when 30 years ago it was at 6 to 8%? And I think things like that really start to put into context of like where these highly leveraged companies that are going to have to refinance debt, it's going to slow their growth even further. And at the same time, it's going to change the way investors think about these companies. And because of that, I know this is very macro. I know it's not exactly like what we typically talk about here, but even if you
Yeah.
are a business focused investor, you still have to pay lip service to the macro environment or the investing environment around you. And so,
I'm gonna push back, Tyler. I don't think this is necessarily macro. It is macro, but this is a fundamental change in the operating environment for debt heavy companies.
yes,
Macro, that's waves, things that come in cycles. This is a fundamental shift. I'm going to say it again. This is a fundamental change in the cost of capital environment for companies that use debt to fund their
yep,
businesses. This is substantial.
yes.
So
And so, if you want to be a conservative investor, I see Intelligent Investor up on Jason's shelf up there. I keep mine right next to my bedstand. If you're going to be conservative, you have to assume maybe this is how it's going to be for a while. And if that's the case, then a lot of these things that people have been jumping into because of yield don't necessarily look as attractive anymore.
let's shift a little bit here, because again, we've talked about the risk. We've talked about the concern and the fact that this isn't just a blip on the radar, and that it's going to likely to be a persistent issue for companies so long as interest rates stay at these elevated levels, kind of more normalized to financial crisis, right? So where interest rates are back to normal for over the long term. Where should investors who are looking for yield, who are looking for safe dividends, stability, dividend growth over time, where do you think is a place that they can invest?
I think that's a very loaded question. I think if you're getting closer to retirement, I certainly think that debt, CDs, more capital,
Yeah, own the
yeah,
debt,
capital
right?
preservation
Invest
is
in,
probably going to be
yeah,
something you're going to want to look at a lot more. And if you
right.
can get debt yielding 5, 6, 7%, that's a decent return if you're looking for a very low risk way of investing your capital. Now, let's say,
That's particularly important if you're dealing with it's cash you're going to need to spend in the next year, the next maybe 3 years, even potentially up to 5 years. Again, if you're in that situation where you're no longer regularly contributing money to retirement accounts and funding your investing, and you're now beginning to live off that portfolio. Tyler,
so
you're a young man.
yes,
I'm a not quite as young as you, man.
oh, close
What
enough.
about those of us that are still looking to compound our
Sure.
wealth? Sure, you can still think about the 60/40 portfolio and owning some bonds, having some cash, all of those things is the balancing act of having a good balanced portfolio. But we still need to focus on growing our wealth over time. Where do we need to be
So
looking?
the one place that I see in kind of this dividend growth space that looks attractive actually is industrial real estate. And I want to point out two companies specifically. It's Rexford Industrial and TRNO Realty. And the reason that I like those specifically is because the growth that they have experienced, and I think is going to continue to experience for several years, is commensurate with the rising interest rate environment. These are the two real estate investment trusts that's focused specifically on industrial real estate in markets where the total square footage of industrial real estate is shrinking. They're in cities, they're in places that are being rezoned for housing, for shopping malls, for everything like that. And in shrinking markets, rents rise faster. TRNO Realty's been seeing lease spreads, which is when you release a building, they're seeing lease spreads in 30 to 40% range, and they focus almost exclusively in the Los Angeles area. So when you start to see things like that, where there's commensurate growth associated with your dividend, that looks attractive. But if you're looking at these slow growth, steady, protect your wealth from a dividend stock today, yeah, no, that doesn't work for me.